TSLY videos. I went to Yield or Seeking Alpha, and I was looking for. I covered your article in part 1 already,
Yeah.
so I saw you. The only two sells were these two people, so I used parts of both of your articles, and then I'm like, hey, why don't I reach out to these people? Because I think there's a podcast I watch where like they do a 3-part documentary, and then the 4th part is like a professional comes on to commentate. So I'm like, oh, let's try that with YieldMax. So
Okay.
I'm like, hey, stranger prop notes guy, you want to come on here?
Yeah. Well, when you reached out, no, it was great to have you reach out, and I was honored. I'm looking forward to it. I think it'll be a lot of fun.
You had some
Not just
great
not
lines
just
in here. I enjoyed
what's
it.
that?
You had some great notes in your article that I guess if you're about to die, you might want to buy Tesla. So
Well, that's the thing, actually. Like, weirdly, if we just want to jump into it real quick, I actually
yeah,
just
go for
published
it.
a few days ago, again on Q Yield. I'm presuming that's how everyone pronounces that, Q Yield. But it's sort of a similar situation with Q Yield. Is that I think, I'm not necessarily as negative as you may be on these ETFs. Obviously, I have them as strong sells because I think most people, like 99% of people, should not buy them. Sort of disclaimer the hell out of that. I'm not an investment advisor, et cetera, et cetera. But as a former professional trader and, long term, I've been trading for almost a decade at this point, and a bunch of that was professionally. I just don't really see where this fits into anyone's long-term sort of ambitions, right? And the only argument is that you could kind of buy it instead of an annuity, which is another product where you essentially say, I don't care about the principal, just give me yield. And in some ways, I think it would be better. It could be better, but Tesla, and that's with Q Yield, where it's sort of a broad base, but Tesla is just hot garbage. Yeah.
People immediately went to QYLD or Q Yield after I talk about Tesla. I'm like, I'm talking about Tesla. Okay,
Yeah.
I'll do this. We'll do this one. Like, I'm not making statements about this one yet.
Yeah.
But yeah, I see the similar problems. Oh, you write a lot of articles.
Yeah, I aim for one a day, but I do not hit it.
So he's Andrew's got his background. Well, you were a professional trader and you worked in derivatives before, right?
Yeah. So
you should explain better than me then.
Yeah. So I was in college. I was the head of my sort of student investment fund. All that, I was very much into trading and finance and stuff like that. And I was actually on the investment banking path. And then I did a bunch of sort of super days and job shadows and stuff like that. And I'm like, these people are really just sort of like used car salesmen. Like, I'd much rather be on the buy side. And so from there, I was sort of enamored with prop trading, which is and sort of that's sort of a misnomer nowadays. I don't know if you're aware, but there's this whole industry that's sort of sprung up called like prop trading, but you have to like pay like this entry fee, and then they maybe give you an account depending on how you do. That's very much different than what I did. It was, I had to go out and get my series, licenses and stuff like that. And then I went to work for these companies. And, I was a trader in college and then did that for several years. And also worked at TradingView, which is a tech company. I don't know if you guys know TradingView, but I was their head of marketing. I was part community, part product, sort of, all over the place, but there for a while. But now I'm back to basically sort of, I know I have a lot of sort of valuable things in my head. And so I've been figuring out how to package it, sell it to people. And right now I'm doing that via prop notes, which is basically.
So were you literally like writing, you were doing like derivatives as like during the day? Like, what does that look like?
Yeah. So I think
a typical day doing that type of job.
A lot of it's research, if I'm being completely honest. I think it depends really what your strategy is. The firm that I worked at wasn't huge in derivatives. Like, there would be oftentimes I'd get calls from the risk department and they'd be like, we don't like your risk here, sort it out. And I'd be like, guys, you don't understand. Like, this is the actual risk. Like, I remember I was standing in line at Chipotle one time and I was on the phone yelling. I was just like, guys, like, you don't understand this risk. Do not take these positions off. Like, the risk is what, they just. So it's both of the firms that I worked at were more equities focused, and I was sort of like the black sheep doing derivatives. But they let me do it, and I was fortunate enough to do pretty well. But it really sort of depends. I would say a lot of it's research. The actual execution doesn't take that long because, if you're set up with sort of a DMA, direct market access platform, there's almost no time that you can go from thought to trade in 2 seconds, right? There's no, I don't think a lot of people know this, but like at a very high level, a lot of the platforms that you use are like keystrokes. Like you'll just type in what you're doing. Like it's all hotkey related. Like you don't really even have to touch a mouse to sort of buy, sell, adjust prices, anything like that. So
how long were they in these positions? Like
my
typically?
typical hold period for, I mean, it really depends. Like again, every trader has a lot of freedom in prop trading, but my typical hold period would be about 30 to 45 days. So again, it's you're not in and out of a lot of stuff. You sort of build a derivatives portfolio, and then over time they would just do better. Then over time, over time you would hope that basically the majority of them make money.
Okay.
Sort of.
Did you hold the underlying assets?
It would depend. Sometimes I would be assigned something, and instead of just selling it, I would maybe sell like a covered call on it or something like that. Really depends on your sort of view of the asset.
Okay.
But occasionally.
So where do we go? So
All right,
this
I was
is
sort of all over the place, but
so I will put a brief bio and his this is his platform that Andrew has. So you're free to go look at it and
thank you for the shout out.
see what you think. Andrew, also, I gave you his Seeking Alpha. You can follow him, which I already have done, I think. Hopefully. Yeah, I am following. See?
All
I didn't
right.
just click that.
There
And
you
you
go.
also said you had a TradingView, which I don't have TradingView.
Yes. So if you go to tradingview.com, I don't know if I can here. Give me to send you the link. Actually, that might help. Also, sorry about my terrible lighting setup. I'm in London, just for everyone who might be watching. I'm in London at the moment.
You can send in the private chat.
Yeah, perfect. I'll do that.
Unless you want people to see it in the normal, but
there you go.
Okay, let me see. Must be the only person that doesn't know what TradingView is. I'm like, trading what? He's like the largest platform in the world. I'm like, oh.
It's basically just like Yahoo Finance on steroids. That's a pretty good way of thinking of it. It's I mean, I worked basically directly with the co-founders on a lot of the products.
So all this will be in the description if you're watching this later. So this is a space that's different to me. So
really,
this is interesting to me. So
yeah,
I've always kind of just been a dividend. I was a dividend focused person for a while because I did really well in the Great Recession, and I just kind of wanted to. I was scared to death of losing it after I got hosed in the .com burst.
Okay.
I kind of I was just like Caterpillar, McDonald's, I don't know, stuff like that.
30.
Then lockdown hit and I'm bored and I'm at home working 60 hours for the government. So it kind of got me going, doing some other stuff. I did pretty well with some, like I had Tesla before it split the first time. Did all right with that. I got to, I think 2 splits into that. I bought Ford at like $4 or $5, which worked out well. But
yeah, nice.
Yeah. So you do.
I think you've been doing this. So you've been doing this for a very long time.
I started in high school. I did one of those fake money accounts with my business class, and it got me perked into it. My freaking teacher though was like, "Hey, buy penny stocks because if a $2 stock goes up 5 cents, you make a huge percentage increase."
Right.
Like that was terrible advice. And then as I'm in high school before the .com, I'm crushing it in this fake money account because everyone was, and I didn't know. But then I got real money for my grandfather and lost half of it real quick. So
yeah, that's how it goes, right? Whenever you inherit money, it's just
so like it's just interesting to see like my first experience basically was like getting crushed, whereas there's other people whose first experience was during the lockdown, killing it with like something Tesla or GameStop or something like that. So again, they didn't really know what they were doing, just like me, but they did really well at first.
There's legend and lore that exists sort of at all these prop firms is a lot of your future. There's been sort of informal studies that have happened where traders will look at different cohorts that come in because you kind of come in like one of 2 groups per year. They hire in sort of classes, right? And or at least the firm that I worked at sort of hired in classes, and they always found that the people who were hired into a very good market for trading lasted the least long. So it's sort of better to get battered down at first and then get back up, because if you do really well and have this huge pile of money that you're sitting on, you don't really know anything about risk management. You don't really know anything about how to trade sort of properly. And it's, the stakes are much bigger for messing up after you've gone on a big run right off the bat. So, hopefully it's probably a good thing that you've, that you had some L's.
I know. I think it helped. And then it helped me prepare for because I 5x and 3x to really good investments during the recession, and it allowed me to like not keep going with that strategy. That probably would have screwed me. If I like, oh, well, I'm an amazing stock picker now.
Right.
I'm going to go full blast. I probably would have lost it all.
Yeah.
Yeah. And that I'm seeing this cycle is very like reminds me of what I've been through.
In what way?
Just like the euphoria. And then I'll see people on, this is kind of why I started a YouTube channel, is that I see these people that they had a strategy that worked during that period of time, like 2020 to like the end of 2021, I think November. But then they didn't learn like, okay, I need to change a little bit. Like they didn't have a recognition that that euphoric market was kind of done. And they just kept piling on their strategy. Man, there were some people that were doing like, they were shorting like QQQ last year. I saw some guy laugh. He was shorting like JP Morgan. And I'm like, he must have been doing some covered call strategy or option trading that worked during we call it the clown market, some of us, during that period. And
you're not wrong.
I don't know. So maybe bring some sanity back to it.
Yeah. Also, I just saw a comment there that said TradingView is good for people that do technical analysis, but they've made strong pushes to fundamentals. And that's true. I was when I got hired, one of the things that they said was like, hey guys, who here at the company knows anything about fundamentals? And I was kind of like, I sort of raised my hand and I had to basically tell them how to like, they were like, okay, we want to improve our stock screener. Like, what should we put in there? And I'm like, oh boy, like, or like, hey, we want to include like macro data, like fundamental macro data for all these companies. And it's like, all right, so here's the checklist, guys. And you just sort of hand it to the engineers and they sort of fix it down the road.
So getting back to TSLY.
Anyway, sorry. Yes.
No, that's all right. This doesn't have to. This is not a. It's just an interview. So like when you look at this, so this was when I did my like a week ago. I'm sure they've changed their holdings. This was like a week ago. Like, what do you think of this? Like just off the bat with TSLY,
I think
what they're doing.
Yeah. So I think it's just sort of the logical extreme of the yield ETFs in general, which is why I think when I wrote about TSLY in that article, I sort of referenced Q yield because it's sort of the granddaddy. And I think that they're not all bad. Like JEPI, I heard you were sort of talking about JEPI, and it may not be the best total return vehicle out there, but I think it's pretty good. I don't think you'll have sort of principal erosion over time because of the fact that they write on very low beta stocks. In addition to so you sort of reduce the amount of swinginess, sort of the W price action that will kill these ETFs really fast. And in addition to that, they write sort of OTM options, which is basically just reduces the chance that they make unprofitable trades and then, sort of distribute those unprofitable, premiums to investors. TSLY is just sort of like the logical conclusion to me of this market. And I mentioned this before, but I'll just go on it a little bit more. I think, I don't know how many people you have who watch you who have traded crypto at all, but over the last few years, there's been like an insane crypto boom and bust. And part of that was in sort of this sector within crypto called like DeFi. And DeFi stands for decentralized finance, but the way that a lot of protocols in that sort of sector would attract trading volume and stuff like that would be they would incentivize people with their own tokens that they could just mint infinitely. And so, you'd log in and you'd see APRs of 10,000%, 15,000%, just crazy numbers. And to some degree, I think that market has learned broadly that that's not a solution or essentially the yields aren't real, right? Because, if something inflates, then the price goes down, et cetera. And I think that stock traders and stock investors haven't really learned that lesson yet is, they sort of they'll see a yield and they'll trust it. They'll be like, oh, J&J pays me, 3%, 4% in dividends. I don't know the actual number right now, but, Procter & Gamble pays me 3%. And it just sort of slowly goes up over time as they grow their dividends and stuff like that. Whereas some of these yields now are getting to the point where some investors are starting to get it and they're questioning. They're like, how is this paying 63% a year? What the hell? Like, what are they doing? Right. Where the yield comes from matters. But I think there's a larger cohort of sort of stock investors who don't care. They don't really do the DD. They're like, well, it's good enough. Like I get my money out. But there's just so many pitfalls with that. So I think that it's broadly, I'm looking at this and it's sort of just like the logical extension. It's just sort of marketing to people who may not understand how it functions, or they think they understand how it functions, but maybe don't really. And
it's funny though, because
you said predatory earlier, and I'm hesitant to throw that out there with my name behind it, but it's not straightforward.
I know. I'm
Yeah.
like, was I too harsh? Sometimes I just go after it. I'm like,
Yeah.
nothing. I don't. And I clarified in my videos in the bottom. I'm like, I'm not saying that they're doing anything illegal or wrong. I think the guy, that Jay Prescatelli or whatever the guy, he's very transparent about what they're doing in interviews. It's in the prospectus.
Yeah.
Like you said, he is created this yield machine where they just give you all the yield. But then you have to give them the money back to maintain the level of income that they're producing for you.
Right.
So like you said, it's like they're printing money to give you, and then you have to give them it back to buy more shares deteriorating to then keep this cycle going. And it's like, where's the income portion of this?
Yeah, exactly. You can sort of look at it like two ways. You can look at it from the perspective of someone who wants total returns, or you can look at it from the perspective of someone who wants income. And if you're looking at it from the perspective of total returns, it's terrible, right? Like none of them have beaten for any length of time ever. Basically, Q yield for the 1 year out of 10 maybe will beat by like 15%, and then every other year it'll underperform by 20 to 30% total returns. And then if you're looking at TSLY, it's just like, and then if you're looking at it from an income perspective, it's like you're not reinvesting that principal. If you need the income as an income investor, you're not reinvesting the principal, or you're not reinvesting into the income generating principal in the first place. So you're just getting paid this stuff, and we can go into the mechanics of how it will fail over time, but
they'll go into it right now if you want.
Yeah.
How will it fail?
So the best way to think about it is like if someone walked up to you and said, "Hey, I have this fund. We take one trade a month, and we're either going to make 2% or we're going to lose 2% on the trade. And whether or not we win or lose, we're going to pay you 2%." You would not invest. You'd be like, "Oh, like that's stupid." But there's sort of this weird mystique that exists around covered calls and premiums where people don't understand. It's like, oh, well, it's just it's cash that's thrown off by the options, or like anything, it's sort of well camouflaged. Like if you break it down to what it really is, like it just makes no sense. Like it's just mathematically, it just will go to zero. So like if you look at it over time, for example, the fund will write a call on its sort of synthetic long position, and let's say it makes money, and it says, "Okay, great, we made $100. We're going to send it out to our dividend holders." When it shorts the call, it's not. I think a lot of people sort of think of covered call trading as like it has max upside, but if something goes up enough, it just has capped upside. It doesn't equal zero, right? Or you can't lose money if a stock goes up. It's just capped upside. But if you do that sort of over time in sort of a synthetic position, what you end up getting is just a very, very high cost basis on your assets, because if you just short a call, that very much is a directional position that you can lose money on. And since the fund isn't taking assignment on any of the executions, it's basically just massively decreasing its future earnings power by increasing the current cost basis. Like it's sort of complicated to think about how the execution and settlement works, but if it sells a call and it doesn't expire worthless, the fund loses money, even though it's still paying out the premium to you. So
I had said
that wasn't too complicated. It's sort of.
I try and dumb it down for people like I am with these, but so I had tried to explain. They make their bets right during the month. If they lose money, they then have to tap into what their cash reserves are, and then they have less money the next month to do this option strategy. So then. So correct me, they either have to go riskier to generate the same premium, or they're going to maintain their risk level, and then they're going to pay you less distributions.
It's the latter. I don't think they increase their risk because they have to follow along with what their prospectus says. So if they're selling at the money, they're selling at the money. They can't really juice that any extra.
Okay.
But I would suspect, and again, I haven't worked at this fund, so I can't speak to exactly what happens.
So there's this part, 5 to 15% above the current Tesla price for covered call writing.
And they'll probably just pick the most liquid of those, right? So if you're looking at an options ladder, I mean, Tesla's by far the most liquid options ladder. But if you're looking at, they probably give themselves a little bit of room to figure out, which is the most liquid. Maybe they'll bake in some market expectations, but choosing where Tesla's going to be 1 month from now is not exactly an easy proposition, even for like someone who does it professionally. So
I said in my video, I'm like, this is what will crush them, right? So when Tesla goes on these runs, because it's highly volatile, you don't partake in that. The yellow line is Tesla. But then when it goes down, you can pretty much see the losses are about the same. And I used November because it was a good example.
Right.
And like over time, this will self-destruct to zero, right? I mean, would you say, or?
Yeah. I think, well, it'll sort of be like an asymptotic. So it'll never go to zero. It'll sort of just permanently decay to zero. Do you know what I mean? Like I don't know if you've ever looked at like those it's like a 3x ETF almost, right? Like it's like SVXY or like any of those that sort of go down. They've got sort of critical mass of funds. They've got hundreds of millions in AUM, so they're never going like literally to zero. But it's just sort of, it's like a half-life, right? So every so often it'll get cut in half is sort of what I expect.
Is there any chance for the NAV to go up of this fund other than just bringing in new money?
Tesla, yes. Tesla would have to go up between 0 and 5% every month, and that would be perfect. So that's it within that very narrow band every month over time. That would be the perfect market condition for.
So just enough so they get their calls over the strike, but they don't get assigned, right?
Yeah. So the underlying stock goes up, but it doesn't go up enough that it goes above whatever call they've sold on, or whatever call they've sold. So they don't lose money. That expires profitably, and the stock goes up. So it's sort of slowly doing this. Like if you look at a chart of Visa, like Visa is a much better stock. Like pull up a chart of Visa over the last 10 years. Like they should be doing this on Visa or just something that's like just very steady, just a very sort of compoundery look to it. But Tesla is like the worst possible underlying vehicle you could ever have for this. And I think they chose it because implied volatility is really high.
And it's popular stock online.
It's a popular stock, and it also just has incredibly high IV, which means that the call options they write are going to produce a big fat return, which is what they, sort of market, right? It's the 65%, 70%.
So do you know anything about these people? Does it matter if they're good or bad? Like this, if they're like, what does being good at this mean? Does that matter to Tesla?
I would argue no. ETFs have prospectuses, so they are sort of locked into a strategy. And when I was looking through, they didn't give their management a lot of flexibility with regards to the amount that it's required to distribute, or the frequency with which it sells calls and then distributes the income. So you could put Bill Ackman in there and I don't think he'd do any better.
So the prospectus says, even if they were really good at this stuff, the prospectus restricts them, that it's not going to make a difference.
Yeah. It's such a mechanical, I think one of the things about options trading is that it's somewhere between art and science, right? And the same with investing, right? You've quant side of the market, you have other sides of the market, but broadly, I think that you need a discretionary approach if you're trading options, and a mechanical approach just isn't suited to.
Right. I think you wrote that or someone else wrote that, I saw, but like, this is not doing this type of derivative trading is not something you should be doing mechanically every month on month. You should have some sort of ability to like use your experience and kind of maybe you don't want to do it 1 month, right? Or you want to go heavier another month if it looks better, like some sort of discretion on your part, not just every month you just write these things. And
right, exactly. Yeah. But it's a specific, it's just an investment product that's designed for a specific crowd. Right. And that's so they're going to not really.
Do you like Jay called it alternative income. Did you like that?
I think that's accurate. I think alternative income is, it's deceptive a little bit because it sort of places it, you think about solar power, wind farms, you think about real estate, you think about, debt liens, like, oh, what's alternative income? But I think from an ETF perspective, if you're screening for alt funds, they'll do stuff like this. They'll do stuff like they'll sell, VIX futures, which I actually have less of a problem with than this strategy.
SVOL?
I heard you sort of not ragging on SVOL, and no. I wrote a relatively bullish article on SVOL because the alternative income implies alternative losses. SVOL to me it's more like shameless almost. So it's like, exactly what your risk profile is. You're just essentially like, vol goes up, you lose money, vol goes down, you make money. And that's a much more strict, like as a trader, like, or as an investor, really, like what you want is something that you can sort of comprehend the risk area of. And I think Q Yield and TSLY are very difficult to map out where they'll be in a few years. But I can look at SVOL and tell you pretty much exactly what's going to happen. Given
my worry with SVOL is you're going to get these people dive into it now because this looked like this was basically the perfect year for SVOL, right? Like the VIX constantly was slowly going down.
Yeah.
But now they're going to buy it now that it's performed well. And I don't think you're going to get that going forward the next 3 or 5 years. I mean, who knows what the VIX will do, but
yeah, I think, yeah, it's all very cyclical. It had a very good year. I think in the future, I mean, even if you look at the underlying though, it's not great. Like if you look at SVOL's NAV as opposed to sort of total return profile, it's not the prettiest thing in the world. Like it requires the distributions to work. So I think this was a good year for SVOL, but again, sort of from a portfolio construction perspective, it's just better because you just understand the spot it sort of occupies from like a risk perspective. So it's just very straightforward to figure out exactly what risk you're taking when you buy it. I think it's very tricky to figure out the risk you're taking when you buy. For someone who doesn't do this, right? Like they just see, oh, Q yield, like it's like holding QQQ, and that's done well, and
because you don't have to worry about
fantastic, and you
don't have to worry about the production and the Cybertruck and Elon Musk going off the chain, right? With this, so compared to TSLY,
yeah, it pays every month, right? And that's the other thing is I think people look at it as like payback period, right? Because they're like, oh, if I can get 60% this year, and then I can get, even if it goes down a little bit, I'll get another 60% next year, and by next Christmas it'll all be gravy. Whatever principal I put in, it'll just be paying out extra. And it's just like with these, the higher the yield, the faster the half-life. So yeah, it's just.
What do you think is maybe there's no answer to this? Is there a responsible amount of yield you would expect with a product like SVOL or high or something like that?
I think JEPI is the gold standard with regards to sustainability. So I think that pays like 9%. Anything under 9 to me with regards to a covered call strategy is like maybe could work depending on how they do it. I think anything above 10, you really got to have a very close look at it. And that's just sort of feel, right? And that's also sort of like, if you look at like, that's in line with dividend paying stocks.
Right.
If you look at, anything above a 7% yield aside from Verizon and AT&T, and you're suddenly like, what's going on here?
I try the problem, like dividend investors I see, is that they look for the current dividend kings to buy. And I'm like, you should be trying to find the dividend kings in 10 years. So it's the same problem, I think, with any investing. You got to pick the right companies. So.
It depends on your goals. Like, I think, I'm very much sort of like, I think there's a school of investing that talks about like dividend growth investing is like the best way to invest, because these are companies that have, they're paying dividends, they have strong moats, presumably they're able to grow their cash flows year over year, stuff like that. And I've never really bought into that. I think if you want an income portfolio, you should just go for income, right? Like Altria, it's not going to grow its dividend, and it may even cut it, looking at it. Picks, okay, I don't know, British Tobacco, like pick something else that's kind of close. Like, I don't think there's a lot of room for them to improve the income, but I also don't think, the amount of time that it would take for Procter & Gamble to get to the level of payout that, British Tobacco is paying out right now, is years and years and years. So I think if you're going income, like go full income. And if you're not going income, go total returns, because, you're sort of in a position where companies that pay dividends are doing so because they don't have places to invest internally with regards to IRR projects. So it's unlikely that they'll be, it's sort of like, there's like, it's sort of like a layer cake. Like at the top, you'll have stocks that I think will produce the most total returns and they won't pay dividends. That's like your tech giants, right? And then you've got like stocks that are high quality, like dividend paying growth, like blue chips, and those are good. And then you'll have like stuff under that isn't paying a dividend, but that's just because it's sort of weak. And then, beneath that, you've got everything else. I think, and so, yeah, if you're not investing for income, like right now, like if you're not retired, then I think you should still be going for total returns. But that's just my own personal, I'm not sure that bears out in the data. Or the other thing is like the difficulty of finding companies that are growing their dividend regularly is much lower than finding the next Google or Netflix or anything like that. So that's sort of the.
I have some questions that, or I was attacked viciously online, no, but about TSLY, and then I guess we're pretty much wrapped on TSLY. And then if anyone has
watched this thing,
if anybody has questions, if you could at me so I can see it on the chat, maybe we'll ask. You can ask. Andrew said he'll answer anything. So these are some of the comments I got from people that were pissed at me. So we talked. The first one was they talk about, oh, we already know the NAV is deteriorating. We don't care. We expected it. I think you already kind of covered that.
There's this weird thing that I've noticed is about like in April of this year, or like maybe last year, I forget exactly when I wrote the article, but my first ever Q yield article, people like had a ton of pushback. They were like, no, like, what are you talking about? Like this thing's not going to zero. Like it's not guaranteed. And I'm like, okay, interesting that I'm getting pushback on like basic math essentially. And what's happened, what's happened over time is it's sort of like people have, I don't know if it's like a Stockholm syndrome where it's like, well, yes, it may go down forever, but it's, but it pays me every month and therefore I don't care. And it's just like, brother, like
it's not investing.
What do you care about? Like, why are you in the markets at all?
Oh my God. Okay.
So there's just this. It's like it's weird. Like they know the risk. It's gone from they don't know the risk to they do know the risk, but they'll do it anyway, which is almost worse somehow. But yeah.
Okay, I got attacked. Someone was telling me that TSLY's stock price will go down, and they noted that it's okay because they can do a reverse stock split, and then they can just continue writing contracts like nothing's happened. So
yeah, I mean it's a NAV thing. Like again, it's just math. Like
it's I don't know how to explain to them. It's math. Like you have less money. Like
it's not math. Like if TSLY goes up between 0 and 5% every month from now until the end of time, it's not math. But other than that, it's math. Like I think, and it's just at that point it's a probability, right? Like what's the probability of TSLY going up?
People want to know USOI. USOI has done reverse stock splits. There's another degenerate contract writing.
What's just for the uninitiated? What is USOI?
So Credit Suisse does this portfolio of it's like equity or
is this like GLDI? I've seen
it's like equity linked notes, but some version of it with oil.
Yeah, I've seen they do this one with there's a SLVI and GLDI, like it's like a 50.
They do a silver one too, I think.
Yeah.
But you can see like here's what they've done reverse stock splits just like these people say don't worry about it. And you can see, like you said, it won't go to zero. But it's just this painful deterioration over long periods of time.
It's just like it's like buying and holding both sides. Like maybe a better way to think about it is like if you buy and hold both sides of like a 3x, like if you buy gush and drip, you'll just lose money over time, right? It's like a similar thing with this. It's just baked in. It's just math. Like there's no stock split that's going to save you here. That's a very interesting one because it just sort of defies. I think they might need help with just sort of understanding the mechanics of a stock split.
Breaks your brain is what it sounds.
It doesn't like if you have a pie or if you have a wallet that has $100 in it, you cut it in 4 pieces and then you change the number of pieces, there's still $100 in it, right? Like, or if you sell the ownership of that wallet, it's just I think a lot of people overcomplicate this stuff, or just denial is very strong within some of these communities. That
the next comment I got from Reddit, the guy said they're going to
hold on 1 sec. I just asked, I saw Andrew Marshall here. How did I get such an awesome name?
Oh yeah.
Great.
Andrew's a good guy.
Great question, really, honestly.
I don't know if you've seen him in some other videos, but he's really good at this stuff too.
Awesome. I'll have to check him out.
A good name, I guess.
Good name.
So some of these people say, oh, TSLY will do better when they redo their treasuries next year from the 0.75 to like a 4.5% rate. Do you think that'll make any difference?
No. I mean, if you look at the yield that it's paying, that's like a drop in the bucket, right? So that's not where the yield is coming from. So thus it's not the problem. And also, I mean, I'm not even sure that are the treasuries that they have now paying.
They're paying 0.75.
Okay, yeah. So I mean, you'll get some more like air quotes real yield from the U.S. government from Uncle Sam, but
it doesn't change
it doesn't fix the underlying strategy at all. Yeah.
Okay. And then we already talked about they all speak so highly of this fund, that J and the asset managers, that they'll perform well. The longer they do this, the better they'll get at writing these contracts. And you've, I think, already said that doesn't matter.
Well, it doesn't matter. And also, if they were a professional already, why would they be getting better? Like, you know, I mean, maybe there's some, I will say this, maybe there's some that might, you know, they're sort of still in like data collection mode. They've launched this fund. Has it been a full year at this point? I don't know if it's actually even been a full year, but I don't see a world where it has a big enough impact to reverse the effect of the math, essentially.
That's fair enough.
Yeah.
We already mentioned VIX. Would increasing VIX, how would that help Tesla or not? If all of a sudden we got more volatility in the market, I guess Tesla's already volatile enough. But.
So yeah, so the VIX is implied volatility, not realized volatility, and so if the VIX goes up, that basically just means that they're getting more for writing upside insurance on Tesla, which is good. That should boost your return as a covered call writer. However, typically the market's pretty good at pricing realized volatility, so it's likely that realized volatility will also jump. And Tesla doesn't tend to move in a way where it doesn't do bad things to the strategy.
So the market's better at pricing in those the changes that you are probably.
The market, well, no, it's just sort of, it's like, yes, the income should increase, but also the chance of like it's such a high beta
losing on the contract, right?
Exactly. It's such a high beta stock that an increase in IV you know, it's sort of like, oh, okay, like the reward is, let's say the reward on an average trade is, you know, maybe it's got like a 70% chance of max profit and like a 3-to-1. Maybe you've got IV goes up and suddenly the premium is a lot higher. So the risk is juicier, but suddenly it's only a 55% chance that it doesn't expire at some point in the money.
Okay.
It's just sort of it hurts I would say it's a net equivalent on expected value.
You might get an increase in the premium or the distributions temporarily, but then there's a bigger risk of you losing value.
There's a bigger risk of the contract just getting taken out and then losing everything. Yeah.
Okay.
Or then basically it costing the fund everything. But yeah.
Okay. This was this was the comment I saw the most.
Okay.
Which they'll say, okay, if I get 50 or 70% yield, so they always just assume it's going to go forward.
Right.
I'll get my money back.
APR guys.
I'll get my money back in about 2 years, and then it's all house money at that point, and I don't care. I'll just let it ride.
That's the gravy thing I was saying earlier. Yeah, like people assume that like they'll just buy it and then they'll just, you know, they'll let it ride, right? But It's just like that only works if you don't care about your principal at all, right? So you can get 100% yield out of this, but if it's decreased 80% in that time, you're only up 20%, right? Like it doesn't. And then if you sort of judge that versus like Tesla, it's on. I mean, I'm not super bullish on Tesla already, but there's just no world where I see it sort of outperforming.